Welcome to day 16 of our 30-day trading podcast journey. Today we are diving deep into a crucial yet often overlooked topic, that is the market psychology and the mindset of a successful trader. You see, no matter how good your strategy is, if you don't have the right mindset, the market will eventually get the best of you. The emotional roller coaster of trading is real. Fear, greed, excitement, and frustration. How you handle these emotions can determine whether you succeed or fail. Today's episode is all about understanding the psychology behind market movements and how you as a trader can develop the mental strength to stay ahead. Let's start by defining what we mean by market psychology. In simple terms, market psychology refers to the collective emotions and sentiments of market participants. This emotional behavior drives market trends and price movements. For example, when investors feel confident, they tend to buy, which pushes the prices up. On the flip side, fear can cause a sell-off, sending prices plummeting. These emotions, fear and greed, are the two most dominant forces that shape the market dynamics. Fear causes panic selling and makes traders avoid taking risks. This often happens during market downturns or periods of uncertainty. Greed pushes traders to chase after every opportunity, leading to risky trades and over-leveraging. The market moves because of these emotional reactions, and understanding them can give you an edge in your trading strategy. As traders, we are constantly balancing between fear and greed, and the emotional highs can be lows and can be intense. Let's break down the typical emotional cycle a trader goes through. Euphoria. When the market is moving in your favor, everything feels easy. You might be tempted to ignore your rules because you feel invincible. This is dangerous strategy because it often leads to overconfidence. Anxiety and denial. When the market starts again turning against you, anxiety kicks in. You might hold on into a losing position longer than you should because you are in a denial about the loss. Panic. As the loss deepens, panic sets in. This is where most traders make poor decisions, either exiting too late or trying to recover losses by taking impulsive trades. Capitulation. This is the emotional low point where traders give up, exit their positions, and swear off trading. Ironically, this often happens right before the market reverses. Recognizing these emotions as they happen is crucial because emotional decisions almost always lead to mistakes. By understanding the psychological roller coaster of trading, you can avoid making decisions based on feelings and stick to your trading plan. Now, let's talk about the most important part of today's episode: how you can build a strong trader mindset. Detach from the outcome. One of the first things you need to do is to detach emotionally from the outcome of individual trades. It's easy to feel euphoric after a win or devastated after a loss. But successful traders view each trade as just one of many. No single trades can define their success. By focusing on your long-term strategy rather than the outcome of a single trade, you reduce your emotional pressure. Embrace losses as a part of the game. Losses are a natural part of the trading, and accepting this can reduce emotional stress. Even the best traders lose trades. The key is to minimize those losses and learn from them. Don't let a losing trade affect your confidence and push you into revenge trading. Practice emotional discipline. Emotional discipline is the ability to control your feelings during the market volatility. One way to do is to creating by clear entry and exit rules. When your decisions are based on predefined criteria, there is less room for emotions to dictate your actions. Practice staying calm and making decisions from a rational place rather than reacting impulsively. Mindfulness and mental breaks. Trading can be mentally exhausting, especially during the volatile periods. Practicing mindfulness tactics like deep breathing or meditation can help you stay focused and calm during the stressful times. Another important aspect of market psychology is the herd mentality. This refers to how people tend to follow the crowd. When the majority of traders start buying a certain assets, others often follow, driven by fear of missing out, that is the FOMO. Conversely, when panic sets in, traders quickly sell to avoid losses, creating a downward spiral. Here's the thing, the majority is often wrong. By the time most traders are buying, the asset is likely overbought, and when most are selling, it's often oversold. Understanding the herd behavior allows you to step back and make more rational decisions, often going against the crowd to find better opportunities. Sentiment indicators. To gauge market psychology, many traders use sentiment indicators, which measure the mood of the market. This can help you see when the market is overly bullish or bearish, which is usually when a reverse is near. Staying aware of market sentiment can give you valuable insight into when to enter or exit trades. Now that we understand how emotions drive the market, let's talk about how you can use this knowledge to your advantage. Avoid emotional traps. The key is to recognize emotional traps like FOMO or panic selling and avoid them. If the market is surging and everyone is talking about the next big opportunity, that's often a sign that you should be cautious. Likewise, during a market crash, when everyone is telling or selling in fear, it might be an opportunity to find an undervalued assets. Stay rational, not emotional. The market thrives on emotion, but successful traders remain rational. By following your strategy and sticking to your rules, you can navigate through the emotional noise of the market and stay on track toward your trading goals. That brings us to the end of day 16. Today we explored the fascinating world of market psychology and how your mindset as a trader can make or break your success. Remember, controlling your emotions and understanding market sentiment are key to staying ahead in the trading game. In tomorrow's episode, we will tackle another essential skill for traders, that is the time management in trading. We will cover how to structure your trading day effectively to optimize performance. Thank you for listening, and don't forget to subscribe and share this podcast with others on their trading journey. Stay focused, stay disciplined, and I will see you tomorrow. Thank you.